Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, March 9th, 2022. It is 12:45 p.m. Eastern Time as I'm starting the video, and what we'll update brief updates on the equity markets, crude oil, lumber, and gold and silver. Those are some of the recently highlighted trade ideas. So we'll start out with the broad markets. I am not going to spend a lot of time on this. There's just not a whole lot to add. This is QQQ. This is the weekly time frame, the most important one, or one of the most important, I should say. They're all important in their own ways, especially in regards to what time frame you're trading and how you're looking at things. But so just to summarize, impulsive leg down. We still have the potential bear flags in play. It's a decent counter trend bounce today, 3.5% right here. You can see upper right hand corner, or if you can't, that's what we're up tonight, exactly 3.5%, which just let me continue to reiterate, because I've been there and done this many times for many years. When volatility is high, we are in a bear market. QQQ, or at least the lows recently had exceeded 20%, the technical definition of a bear market. And so when you're in bear markets or correction mode, the S&P even entered correction mode, volatility increases. So your daily swings are going to be 3+%. That is the new norm. When volatility is low, it's rare to see a 3% up or down day. So don't read too much into how much we're up, how bullish it feels if you're long and enjoying that rally, or if you're short and you're seeing your profits on paper go down today. Hopefully you're diversified. I talked about that yesterday. We'll get to that in a second with crude oil and lumber and some other things. But that's it. So the biggest picture here, most important, that was a big level here. T1, my first target, about 342 in change, roughly. It was hit here a few weeks back, bounced as expected, reject off the 200 days. And what I want to point out is, as of now, these potential bear flag patterns are still in play. You've had all red candles, including this one. As much as we're rallying today, we're still red for the week. Now, this candle will not be finalized until Friday, 4 p.m. Keep that in mind. Is it the end of the world if it's green? No. Does it help the bear flag scenario? Doesn't help it. Works against it. But, here's in case we had one green candle on the way down. I pointed that out, and we already had one green candle. So ideally, for the bearish case, you'd want to see a rejection, a red candle this week. And as I like to say, the redder the better. And I'm talking about, to increase the odds my next target's going to be hit. Also want to see on a weekly basis, a weekly closing basis, end of day Friday, I want to see us remain under that former first target, which was support, now resistance. So all we're doing, just like I pointed out in the financials today, we're back testing. We already actually broke down and back tested for 2 weeks, and we've already started moving lower. So let's see how we finish the week. Can't read too much into it on the weekly time frame. Now I'm going to jump all the way down to the 60-minute and just continue to reiterate or harp on this trend line. It's nothing, it's not the longest term trend line, doesn't have the most number of reactions, but there's enough reactions there to validate it. And so that is certainly a potential bounce target if there's going to be more upside today or into the end of this week. And if we take that out, there's still plenty. You turn off all the lines and you still have nothing but a pure downtrend, which is a series of lower highs and lower lows, and that downtrend doesn't even be called into question. Now, keep in mind, when you can take out a previous high, it doesn't mean that the downtrend's over. But just saying from a nice clean view of that. Make no mistake about it, we're still in a downtrend, and this counter trend rally is nothing more than any of these other ones were so far. And so that way it works is, I want to see, ideally, again, for the bearish case, that we're going to hit the next downside target, see us stay below that trend line. And also, if that's taken out, obviously, if and as each one of these previous reaction highs are taken out, and as key Fibonacci retracement levels are taken out, and then you start getting to that weekly chart, some of those resistance levels, the key 40-week moving averages, that's so it's an incremental process where you go from where the outlook for the outlook going forward becomes either more or less bearish. So it's a constant constantly changing thing. I always say the charts are dynamic, so we'll watch that. But as of now, there's I still view any counter trend rallies, including this one, as objective levels to short. Now that is also very dependent on everyone's unique positioning. And what I mean by that, if you're already fully short, whatever amount that you say, this is my, as much as I'm willing to go short on the markets, if you already have that full short exposure, you don't keep adding. I point these levels out because there's all kinds of traders, people coming in, some that aren't short, some that are long. And others that maybe cover and play the rips and dips. And so when I speak to objective entries, that's what I'm talking about. So all right, let's get away from the that for a second. One quick look. I'm going to keep it here on the just for now. We'll keep it on the Nasdaq 100. There's other indexes out there, but the S&P is looking about the same right now on the futures and the SPY. So here's where we're at right now. We did take out on the futures. We took out that previous reaction high. So you do have, which is something to note, the early makings of at least a very near-term uptrend here. A series of higher lows so far, right? And also a series now with this pop today of higher highs. Next one is here, and again, then you have these highs and so forth and so on. This, by the way, is just a 5-minute chart, just showing the last week of trading price history here. So very short-term chart. You can see we're at resistance right now, about 13,745 or so. These are all just very minor short-term resistance levels. Like I said, the most significant one is that 60-minute downtrend line on QQQ and NQ. You can see it here on the NQ futures. So that's it, and be ideal. The sooner you turn down, the better. But if you get up there, then that would be, in other words, that would be a more objective entry than right now. Right now, we're really not really. We just took out minor resistance. Or of course you take out the recent lows. Take out that low, you're probably going to take out that one because now you've foiled this whole near-term uptrend thing. So that's it. Near term, kind of your guess is as good as mine. So that's why yesterday I talked about hedging up, shorting gold and silver and crude oil, which are effectively hedges. And so far so good. Here's crude oil. Remember we put in that this is that I ended the video yesterday. I started it with a 60-minute chart and then went over to this 120-minute chart, meaning every candlestick is 2 hours of trading, and talked about the potential for a 20 or so percent drop in crude. So far, from where the breakdown was, so far it has been. It's almost to the button, a 20% drop off the highs right there. Remember, I was pointing out yesterday we had a divergent high, then this trend line. That trend line did break, and you can see this is the beauty of technical analysis. I haven't modified or touched that since yesterday. There's the break, and you can see nothing but pure waterfall type selling, and that is what happens in a crowded trade. That's why you don't want to short crude. I'm sorry, you don't want to go long crude when it's gone nearly parabolic and you have divergences and all that. Do I think this is the top? No, probably not. So I covered up right here today. And I told you we could go down, and we still can, to that other longer-term trend line. Again, referenced yesterday's video was towards the end of that video was the last security I covered. So this is still a potential target, that uptrend line, but that was pretty darn good support. And remember, that's a 20% pullback, and I think that cleared out a lot of the excessive bullishness and excessive long entries. You can get too lopsided a trade, meaning not enough shorts. All the shorts were blown out right here, and all the longs, especially the Johnny-come-latelys that want to start buying crude oil there when it's had that kind of run. I think it's safe to say that at least a good percentage of those longs were cleared out. Their stops were cleared out today, and so now where we go from here, I don't know. Just that's it. These are the same levels. Resistance. This was support right here. Remember that was the. Let me zoom back in so you can see it there a little better. We had that reaction high there, that reaction high plus a big old gap. Back tested it once, twice, and third time's a charm. And then just took it out there today and had a quick kind of mini crash. And again, those mini crashes come from lopsided trades. And one point, if we can take out the recent lows in the stock market, I think you'll still see that. As much as bearishness has certainly ramped up with the bear market of the 20+% drop in the Nasdaq 100 and the 10% drop in the S&P 500, we have not come anywhere close to my my buy signals on the put to call, especially the equity put to call ratio, where other previous corrections and even bear markets have ended. That's telling me there's still not enough fear in this market. At least again, that's one of my most reliable indicators. So that's that. Congrats if you caught any of that crude. And look, you can trail it down. At this point, you probably want to have your stops right above that 1277 level if you shorted it anywhere in there. And if you get a back test, maybe a back test would be an objective short entry. But again, I just can't say. It's hard to say if the top is in on crude. You really won't know for a while. And I'm not trying to, at this point in time, call a major top or in position. I just get in and out. And then I told you there's a lot of headline risk with crude right now. So it was more of a hit and run kind of, and a hedge trade, which again has really helped to offset, the give back on my short positions today. As did lumber. Lumber hit or came close to my second target. It bounced off the lows so far. Let's look at that real quick. This is LB Lumber Futures. I gave you the setup using a I believe I did the 2-hour candlestick chart, 120 minutes, and had this bearish rising wedge. First laid out as a setup. I like, when possible, to get trades out to you first as setups, so that way when it triggers, you don't have to wait for me to mark up a chart or do a video. You can jump right in. And if you did, so far it's been good for, didn't mean to do that. Let me grab that chart again. LB, so far from the breakdown point right there, it's been good for a drop of about 11%. So that should be, probably, oh gosh, it's over 100,000 a contract. It's a leverage factor. Remember, you don't put up 100,000 to short lumber. You put up a small fraction of that because futures are leveraged. But that's, per contract, you made, probably 13,000 or something more so far, taking the breakdown. And look, we're still not to my first target, and I'm sorry, that was my first target, second target, and I still think we come down. I'm still preferring a swing down here to at least that 1022-ish level right there, maybe cover a hair above it, potentially down here. So as of now, still looking good. I just want to mention, so that one's also offsetting any losses in the equity markets today. And as is any shorts on gold and silver, as I had mentioned also yesterday, because the logic is this is certainly, it finally got its credit back. Forever and a day, they've written off, a lot of pundits have written off gold. The whole flight to safety thing is done now. Bitcoin replaces that, and then finally, gold needed to break out technically, which it did. So I'm not going to rehash that. You can see my old analysis, recent analysis on the weekly charts. But we broke out of that triangle, and it was a big run up. And as I said, this coincided with the previous all-time high, or multi-decade high. I believe that was it was all-time high, because that's where we hit back from the last bull market, and we hit it about a year ago. Anywho, so that was one of the reasons I said for a short there. And then we did, there was a trend line there which we took out, and we went on, we hit, and it took out that 2007 target support, and next level's right here at about 1977. I had at least one person asked, hey, I'm looking for areas, objective levels for gold, and that's what I point out. So look, you're darn close. You came close enough today. I put coin toss odds. Remember, gold's in a strong bullish trend right now. It's fresh on the heels of a breakout. So although this would still be, and we may get there, an objective level, that uptrend line, this right now may be it. And I could tell you, if you were waiting to buy gold and you didn't buy this, I don't know when you're going to buy, because you may not get this. Now look, anything could happen. We could do that. I'm just pointing out objective entries, and that was certainly one today. Also an objective area to cover a short trade if you shorted gold or silver like I did yesterday, to hedge up, because again, where I was going with that earlier is, gold has been right back on lockstep with a flight to safety bid in the market, meaning going up as stocks were falling, and then the last couple of days stocks went up, and you can see that flight to safety bid has come out of gold. So they're working as they often do during periods, not always, but many times during periods of market turmoil. And gold's works trades at that point inversely to stocks. So by that logic, being short the equity markets and short gold at the same time it's an indirect hedge. A direct hedge is if you're short something, you buy calls on it, or sell puts. You can do things like that or own the shares outright. But this was an indirect hedge. Anyways, it's paid off nice so far. Just want to show you the levels. We're at what could be the end of it. And again, if we have a little more downside, it's not much more. You hit that trend line again. It depends if and when we get there. You're talking only about, depending on how soon you get there, about 2.5, less than 3%. And again, it comes in at higher and higher levels every day. So if we bounce around for a while, and then maybe you don't even have another 2% downside in gold. And if you take it out, not the end of the world. I'll give you additional levels. The break, as long as that breakout holds on the weekly chart, I'll continue to view pullbacks to support as buying opportunities. So that was gold. The other one I gave you was silver, and there was silver. I gave you the same thing, an uptrend line. That was comparable to the trend line in gold I just showed you, and then I gave you a smaller minor uptrend line, which has now been taken out, and I gave you this support level here, 25,673, which we're not to yet, but very close. So there's your cover, your short or buy point if you shorted silver as just a quick tactical trade or a hedge. And should we go any lower and you want to just ride it down, you can also trail your stops down, try to cover on this line or go long. But again, we may or may not get there, and that's why if you're short, that's what trailing stops will do. They'll allow a trade to run and let your profits build while minimizing your give back if it suddenly reverses, and let's just say that's the end of the run there. So yeah, that's it. That's all I wanted to do. I've told you I'm going to work towards getting some of these shorter videos out during the day. My title on the original post, if you as a subscriber, you automatically signed up for email notifications of new posts. If not, let me know. But those are part of the site. You can always unsubscribe from them, but that will get posted out to you right away. And this one I showed you earlier today, and I'm just going to update it because it's an important sector. The yellow line was a key level, 3711, and we're back testing that. We broke down. It was impulsive. Everything I want to see. I added a red line. Well, no, T1. That level was there all along. This is still essentially an ongoing trade from back here, and I called and I maintain a major top, and I always talk about this. You probably heard me say this before. To me, in trading and investing, there's a huge difference between being early and wrong. Being early on a trade, which by the way, we already hit our first target, so technically it was successful, but this was my final target, and I'm probably going to add additional targets, and I'll still maintain these. So being early, as long as a trade is not stopped out, and I already went over this recently, it did not exceed a reasonable stop loss ratio, 3-to-1 risk reward. If you're holding out for T3, the final target, then this is just a kickback rally. You went slightly underwater if you didn't cover at T1, but not well within a normal parameter if you wanted to give a normal stop if you shorted right here on the breakdown of the original sell signal. And so where I'm going with that is, so this is either a continuation of that trade, still think we're going down there, and again, another counter trend rally, and you have a nice clean downtrend line just above the price resistance, as well as a gap right there. So you can short up to, as I said earlier, but not much above that downtrend line. And then you may want to, you can keep tight stops right above it in case they pop that trend line and backfill the gap and then keep going. Or if you're, depends again on your entry. So I'll always point out these objective entries, stops. I used to give on the trades specific stops, but that would require you getting the entry right there. And I've learned over the years, many times people aren't around. They don't take the first short entry. They want to, or long entry, a long trade. They want to go in after the trade starts to pan out. And then I'll point out, as I've been doing on the stock market, additional objective entries. So everyone's going to have different cost basis, different entry prices on trades. Therefore, your stop is not going to be the same as my stop or the guy or gal sitting next to you. And so that's why I talk about stops kind of, again, objectively, and conditionally, depending on one's entry price and what their price target is. Because some people might go for the quick trades, they might be active traders, gaming all the bounces off the initial tags of each target, and others might just be a trend trader, position trader, and want to hold out for the whole move and ride out any counter trend bounces. All right, let me wrap it up here, get the video out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great day.